Welcome again, everyone, today to what is our last ShareCafe Hidden Gems webinar. I know there's probably everyone's sighing going, oh, but this is the last webinar for the year. It's been an incredible year for markets and also an incredible year for our lives. There have been many COVID winners and many COVID losers. We've had some industries like travel that might be scarred for life, and we've had others emerge like the electric vehicle battery. So there'll always be new investment opportunities. We've also had some outstanding performers from our hidden gems presenting companies. We've had over 100 companies present, with around 45% of those doubling in price. Some of those outstanding performers include Race Oncology, that was on last week, up 1,200%, Australia Resources up 900%, Element 25 up 800%, Marley Spoon, Wide Open Agriculture, Predictive Discoveries, Arden, Digital Wines, all up over 500%. Now, we also know that it's a market awash with liquidity, and there are literally thousands of new investors in the market for the first time. Now, they're all attracted to that smaller and micro cap end of the market, a market we know where there is really very little broker research coverage. So investors need to do their own research and tread carefully. After all, this is not an average marketplace. So the purpose of these webinars has always been to educate and inform and to give investors access to CEOs via Zoom. Thank God for Zoom. Speaking of which, if you'd bought Zoom shares at the beginning of COVID, you'd be up 400% on your investment right now. So businesses that we used during COVID have been great investments. Now, if you want to ask a question, type it in the little green box, and we'll go from there. There's CPD accreditation for advisors. First up today, we have DomaCom, ASX code DCL, market cap of around 20 million, 1 year return of around minus 11%. What does the company do? It's an innovative new fractional investment platform. So for as little as $2,500, you can invest in any property, residential, rural or commercial, anywhere in Australia with your friends or family or other investors. We have with us the Executive Director, Ross Laidlaw. Ross, thanks for your time. Over to you.
Thank you very much, Tim, and thanks very much for giving us the opportunity to talk about DomaCom. DomaCom is a fractional investment platform, and what does that mean? What that means is that DomaCom breaks high-valued assets down into bite-sized chunks so that it's available to retail investors. And we do this with properties of all descriptions, as Tim was saying. We've done this across mortgages and loan structures, and also infrastructure assets. We actually completed a wind farm co-investment. So fractional investing, breaking down large assets into bite-sized pieces, and therefore really allowing the retail investor to get access to these assets. Next slide, please. The other side of the coin, and something that DomaCom has worked for many years on, was the equity release. So this is the opportunity where retirees, and very much food for thought at the moment, where retirees can release equity in their home, so they can sell a bit of equity in their home. So the other side of the coin, and we'll talk a little bit more about the equity release product. If I can have the next slide. So DomaCom, in terms of what is the DomaCom distribution strategy? Our distribution strategy is very business to business, so it's IFA, so we're an intermediated business, and we've been going just on 9 years, and over that time we've built relationships with the IFA market. So we today have over 45 different dealer groups, as they're called, that have approved our products. So that gives us access to over 1,000 advisors, and we've actually completed over 70 transactions today. We also work with affinity groups, and they're becoming increasingly important for the DomaCom distribution. And when I talk about affinity groups, I'm talking about the renewable energy companies and some very large players that are coming into this market, property developers, and also other companies that are looking to use and white label our products. What we've been able to achieve through some cornerstone investments, and Halo was the first in that, is for them to really build the business to consumer end, where they've actually got a distribution out to the end investor. So Halo, an investor of the DomaCom ASX company, and we're looking to have our second one of those, and I'll talk a little bit more about that during the presentation. If I could have the next slide. In terms of our products, so DomaCom's products can be really broken down into the fractional investing product, which is very much targeted to the SMSF market. And as we know, the SMSF market is a significant part of the superannuation industry, nearly 700 billion in assets. 50% of our investors today actually hold SMSFs. So that's targeted to them, where they can actually get a fractional interest in property, mortgages, or other assets. We've got the equity release product, which is again targeted to the seniors market. And the other product, and we're all in the hunt for yield in this time of the market where interest rates are very low, we've actually run pooled mortgage products. And we've actually got a client now that has over 20 million in the pooled mortgages. So that's giving first registered mortgages and high yielding returns for their investors. If I could get the next slide, please. DomaCom's worked very hard during its development. We still see ourselves as a startup, but this year I think is going to be a significant year for us. And we've worked hard, even though it's been a tough year with COVID. We've got a new product, and I'll talk more about that, the Rental Property Accelerator product. We've got an ATO ruling on the downsizer. We also have developed a relationship with an affordable housing, which will be a significant event going into 2021. But if I just point at just another very significant transaction for us and transformational is that we're working with a group, and this is public knowledge, AustAgri, which is building businesses from what they call in the agricultural space, of course, from the pasture to the plate. And that's a significant transaction where they'll be looking to onboard their assets onto the DomaCom platform, which is something in the vicinity. We're just undertaking due diligence, but it's in the vicinity of some 300 million, and we'll provide with a revenue recognition agreement of about 2.6 million per year on the basis of those assets then coming onto the platform. If I could have the next slide. This just shows you our growth, and we've got some 75 million. We believe that's going to grow significantly with the things that we've got ahead of us next year. Next slide, please. I just wanted to, the key drivers, and I think this is where we've set ourselves up going into 2021. As I talked about the Rental Property Accelerator product, and I know we've got limited time, but what this has allowed us to do is actually to buy property at 10% discount to the market. And I actually mean a discount because we get all the properties with a valuation. That 10% discount goes to the investors. A part of that we give to the tenants in the form of a tenancy. They get equity in the property. So it's actually getting tenants on the property ladder, but it's also looking to get good tenants and having long-term tenants, but allowing them to get onto the property ladder. We've already done 3 properties in this area. And we believe that's going to be an exciting property moving into 2021. The affordable housing. So this is significant development. This is actually the same concept, but working in the affordable housing area. So we've actually signed an agreement with Blue Chip, which is a community housing provider, a tier 1 community housing provider. And we've got a pilot program for some 250 million in affordable housing over the next few years. That'll be 100 million that will actually be borrowing from the government. So the government set up a government bond program to borrow money cheaply. So you're borrowing money at 2%. We will have essential workers renting these properties. So effectively they're paying 75% of the market rent. So hence it's still attractive for our investors on a yield perspective. So, and it's actually increasing. As we know, there's been a lack of supply of affordable housing. NDIS is another important area and limited time, but we've actually got 2 of NDIS properties moving, and they're ahead as I speak, and they're again very much a yield play. The other exciting thing we've got coming, we've been working hard on that this year, is in the Islamic community, actually building a Sharia compliant product. Traditional Muslims cannot actually borrow money, so they actually they're not allowed as a Sharia compliant product. So we're working on a product which will get a tax ruling that will actually be Sharia compliant, and we're working with a major distribution client on that. So we believe that that's going to come on board more into the second half of next year. The other important development, more for our equity release product, was the downsizer. As people who follow the financial markets, downsizer really only applied to people that who were actually going to move house. You know, you could, if you're a retiree, you could sell your house and put 300,000 into your superannuation retirement income. Here, DomaCom is the only product that's actually achieved where you can stay in your home, sell some of the equity in your home and put that money into the superannuation product. So that's a significant development for us. Next slide, please. Please move on, because I know time's again, and this one, please move on, because we've really spoken about those. Again, just on the senior equity release, I would only just add that we've just had the retirement income review that has just come out at the just recently. And again, the house was, there's been more conversation about how you can use the house to help your retirement, which previously that was sort of a no-go zone. So this again is feeding very well into DomaCom's equity release equity release product, I should say. Next slide. So look, I think, you know, DomaCom really has built products for the landscape. In terms of self-managed superannuation funds, many of those it's become harder and harder for them to actually get leverage if they're wanting to buy properties. DomaCom's product actually allows, we actually are able to borrow within the product, so it saves them getting limited recourse borrowing. We've also, you know, the property, you know, in terms of where we've had an oversupply in the property market, DomaCom through the rental property accelerator has been able to take advantage of that vacancies that have existed. And again, in the self-funded retiree area, helping people through the equity release product support their retirement so they have a good and healthy and happy retirement. If I can have the next slide. This just really shows you our fee structure. So again, it's fairly standard in terms of the different asset classes. So, you know, no surprises there. We earn our fees in terms of the assets under management. Next slide. So look, I think in conclusion, you know, I really think that DomaCom is very primed for growth into 2021. A number of things are aligning for us. As I said, we're getting good traction on this rental property accelerator. The affordable housing is a very significant win for us. To building the Islamic product. I talked about the Agri transaction, which is transformational for the DomaCom group. So, you know, we really look forward to 2021. And just on the last slide really just shows you the share price of the DomaCom fund. So I think I'd leave it there. Thank you very much, Tim.
Thanks, Ross. A couple of questions. From a practical perspective, there's lots of products you've shown there. And if a house is for sale and people are, you know, putting in small bids, when does the house sell and when doesn't it sell? Do you have to achieve 100% bid for the product?
With our normal product, we have a full process there, Tim. So a campaign is run. So initially a campaign. So let's say the house is $1 million and we're going to borrow. We have an arrangement with La Trobe. So let's say we're borrowing 40% of the money. So we have a capital raising program. So we raise 600,000 and then we get the loan from La Trobe. So yes, we need to have all of the money to actually, because the property is then bought in the name of our custodian.
And you mentioned kind of different generational groups. Where's your sweet spot at the moment in terms of where have you seen the growth?
Well, look, I think it's still in the accumulation area. Certainly, you know, through our financial planners and people. But having said that, as I had mentioned in the presentation, we've seen significant growth in our mortgage pooled mortgage product. So people hunting for yield. You can get attractive yields. As we know, a lot of the banks have moved out of this market, and you can be earning, we're doing some developments where those yields can be in the 7s and 8%. So we're a business to business, so that's really the financial planner who's dealing with the client. So, but we really do feel we've got products for all of those ages, for the accumulators and also for the let's say the retirees. They're actually, hence the equity release product.
And I mean, you're a small company and you've got lots of different products, a big, broad product set. Is that one of the risks, that you're kind of offering too much to a broad market?
Look, we don't believe so. Remember, we're sort of the machine, we're the engine. We work with, we don't know property per se. We're not property specialists, so we work with property people. So in a way, we plug in to the market that is out there. But we do believe we've got products that are, from a demographical change, affordability, they're, in some ways we're becoming, and it's maybe not through the vision per se, more of an impact style of fund, because of looking at affordability, looking at retirees and their retirement, renewable energy. We're getting quite a lot of interest in solar farms, wind farms. So yes, it's a good rush.
And I know there's kind of a lot of regulation and compliance around that. How do you tiptoe through those different avenues?
Yeah, but look, we do, but in some ways that's very healthy, because we have a full due diligence. And once you do it, as I said, we've done it 70 times, but no property gets put onto our platform. And once we've done our due diligence, so the valuation must be within plus or minus 10%. Right. And we've had some situations where people think, oh, it's worth this. Well, it isn't worth that. So we will not onboard unless it has been independently valued. And we value all of those properties on a regular 12-monthly basis, because we are a retail managed fund. So we do have very good controls and processes in place, and it's all there to protect the investor.
Ross, thanks for your time. That's all we have time for. We'll see you again. Have a good Christmas.
Thank you very much, Tim. Thank you.
Next up, we welcome back Little Green Pharma, ASX code LGP, market cap of around 81 million. The company hasn't been listed for 12 months, but when we had them on webinar back in April, the share price was 20 cents and it's around 60 cents now. Little Green Pharma is probably the leading medicinal cannabis company in Australia. It was the first company to achieve production of a locally grown medicinal cannabis product for patient use. We have with us this time Paul Long, the Chief Operating Officer. Over to you, Paul. Thank you.
Great, thank you, Tim, and thank you to everyone for joining today. We'll begin with a bit of just a short company overview. So, as Tim mentioned, we were one of the early movers in the medicinal cannabis market here in Australia. So we received just the third license to cultivate and manufacture medicinal cannabis for use in the country. We had one clear vision right from the start, and that was to bring the very first locally grown product to market. And we achieved that in August of 2018. And in fact, the second product to market that was locally grown was several years later. So that was a big milestone and a critical milestone for our market share. And we think that has set us up really well as this emerging market grows here in Australia, but also into overseas markets as well. The company is a vertically integrated company. We've specifically chosen to do that as a company so that we control everything throughout the value chain and optimize margins. I'll talk a little bit more in some of our follow-up slides around what that actually means and elements of our manufacture, all the way from our cultivation through to manufacturing and distribution. We recently re-rated our cultivation facility up to a capacity of 3 tonne, and it's grown here in Western Australia and manufactured also here in Western Australia, but servicing countrywide and more recently into European markets. The interesting thing about it, or the point to make about our shareholding structure, is that we have a very, very motivated executive and board as a company. You can see there that we have a board ownership of over 20% of the company. In fact, Fleeta Solomon, our managing director, and Angus Caithness, a board member, have a combined 19% of the company. So I guess the point to make there is the company is incredibly well aligned to shareholder value. On a capital structure, we have certainly in the last 2 weeks, I think 2 weeks ago, our share price was 45 cents. And so we've certainly had a good run over the last few weeks, which has been fantastic. And we will continue to see, we think that this emerging market is beginning to open up more broadly, but certainly in Australia, we're now starting to see some month-on-month growth trends and more doctors in particular as key stakeholders beginning to prescribe the product. I think the one thing, just back on the previous one, sorry, Tim, the one thing to note there is we do have a very strong balance sheet. We've spent all our capital, so capital to invest in our infrastructure from a cultivation and a manufacturing side has been complete now. And we don't have a need per se to go back to the market. So we're in a really strong position for growth into 2021. Thanks, Tim. I think the reason why we point to this slide is it's really, really critical. The industry, the medical cannabis industry in Australia and globally is certainly flooded in some sense. And for us, yes, we are absolutely driven by and motivated by shareholder growth. But what's really been important to us from a business from day one is really thinking about the patient. And we have a clear purpose, and that is to reimagine cannabis medicine and do extraordinary things for our patients. And we've done that from day one, and we've built we believe, one of the strongest brands in market, which will be critical to our future growth. Thank you. So jumping now, give you a bit of a background as to the full supply chain. So beginning with the cultivation facility, as I mentioned, we've got an indoor facility here capable of producing up to 3 tonnes of dried cannabis flower, which has the capability to produce us up to 300,000 bottles of medicinal cannabis oil per annum. We also have an additional capacity, if required in the future, to double the size within our existing structure here in the southwest of Western Australia. And I think what's important to note here is that we are not actually limited by the scale of our operation. We currently use high quality imported material as well from third-party cultivation facilities from both overseas and here in Australia. And so our capacity to grow the cultivation and production is significant. Where we see our future in cultivation inside our existing indoor facility is actually producing flower as a finished product, which, believe it or not, is more difficult to produce than an oil. And the reason for that, specifically for the European market, is the specification limits on release must be plus or minus 10% of your active ingredient. So if it's a THC 20% product flower as a finished good, it must be reproduced every single time to meet label claim. So that is something that other operations that are not indoor or perhaps outdoor or glasshouse operations will actually, we believe, struggle to achieve. And for that reason, we think the flower market, particularly into the European market, will be strong in the years ahead. From a manufacturing perspective, we recently announced that we received our Good Manufacturing Practice license, and we've done that on the same site as our cultivation facility. So that was a huge milestone for the company. It's been something that we've been working on for a number of years, and we are very close to releasing our first products, and our first GMP flower products will be at this stage sent to Germany early in 2021. Really in the middle there, the product development, this really is at the heart of what we do as a company. This is really, really critical. So and also the foundation of really where we began as a company. But we've closely partnered with Curtin University, and we're working on we have a global perpetual rights to what's called an Arise technology, which is a small particle delivery technology specifically for the global medicinal cannabis product. And for us, we have the capability to be focusing on the market and selling our oil-based products and a broader range of products into the market. But the big play for us really is the drug delivery technology and bringing that out into market as we push towards the drug registration pathways. As a company, I think we've really excelled in our sales side. And when we say sales, we're talking about patient access and education. And this really is one of the key reasons for bringing out the first product, and why we were so driven as a company to bring out the first product to market, was to position our company in a scenario where we could educate all our stakeholders, including patients and doctors and healthcare professionals. So we continue to do that. We've built technology such as our medical portal, which enables doctors, streamlines the whole process for doctors to access all the information they require to prescribe medicinal cannabis. We're continuing to look at partnership opportunities to make this product more affordable. So we recently announced a partnership with the HIF, health insurance company, and they're actively promoting their product to their members, and it's been a really successful opportunity for them. And we're actively in discussions with other health insurance companies with the ultimate goal of creating a more affordable product for Australian patients. On the sales and distribution side, this really is the big prize, and we spent a lot of our time focusing on this. In Australia, we have got a really strong market share, somewhere between sort of market share number 2 or number 3. But certainly we've been working really hard in the European states countries to actually position our brand in those markets. So we've shipped 2 commercial shipments into the United Kingdom, and we recently shipped our very first product into Germany. That was over 2,000 units. And in fact, it was only the 3rd company in the world to send medicinal extracts into Germany, behind $2 billion Canadian companies in Aurora and Tilray. So that was a huge milestone for the company. Next one. Our growth strategy is actually really simple and really clear for us. So we begin in Australia. We see the Australian opportunity is significant, and we're here today, and we'll show you a growth chart in a moment on Little Green Pharma products in Australia. But we, as a country, I think we're probably around about 45,000 patients now in Australia, active patients. Now, independent research talks to there being roughly 2 to 3% of the population by 2025. So, I mean, if we look at that as a number, it's somewhere between 500,000 and 750,000 patients in Australia in the coming years. We're only sitting at 45,000 patients. So there's a huge growth opportunity just here in Australia. And in the position we're at in market share is absolutely critical for us to maintain and grow that position and to consolidate our position in the market. And first mover advantage has been critical and will be critical for that. But the international markets is probably where the big prize is. I think if we look at the size and scale of countries like Germany, which we've just recently shipped to, the challenges in actually delivering a product to Germany. There's lots of cannabis companies out there that talk about shipping to Germany, but very few that have been able to actually deliver. And it is incredibly difficult from a GMP perspective to do that. So Germany is a big market for us. France it will be an emerging big market for us. We're actively working into South American markets, and we've got other emerging European markets like Poland and Denmark that we're working on as well. And really, as I mentioned before, the end game really for us is about the innovation. And we have a team of people that are dedicated to the future research and innovation within this industry. Next thing. A quick snapshot of the company, and the track record. You can see there that the growth in a month-on-month or quarter-on-quarter is significant. Even just in our September quarter, our patients were up by 58%. You can see the revenue growth has been compounding since day one on a month-to-month and a quarterly basis. We expect this quarter to be no different. In fact, we expect 2021 to continue on a similar growth path. For us, 2020 with COVID has been a great year. We started the year with an estimated 11.5% market share in Australia, and we end the year with an estimated 16 to 17% market share. So there's only 1 or 2 other companies with that market share scale at the moment. So it's certainly been a breakout year for the company. Thanks, Tim. I'd like to give you a quick tour of our facility, and I'll talk you through as this video plays, hopefully. So this facility, as I mentioned, is based in the southwest of Western Australia. The video you're seeing here is actually our mother room. We use mothers to clone genetics to actually grow, put into our flowering rooms. From the mother room, we take our cuttings into propagation. You'll see here our clone domes. We take cuttings off the strong mothers, and they spend about 2 weeks in the clone domes, and then they transition into a potting room and then a vegetation room. So the vegetation room is there. That's really where the plants spend a number of weeks inside that room, building some strength before they go into the flowering rooms for roughly 8 to 9 weeks. So the flowering rooms will use certain lights and certain fertigation to maximise the flower and maximise the yield, which is where we extract the medicinal qualities from. So once we've grown and harvested, we go into these drying rooms. This is where our GMP begins, our good manufacturing practice. The plants dry down to about 11% moisture, and then we move into a bucking and a trimming phase. So you can see here, this machine is trimming the down to the flower and trimming off the leaf, and then we move into a production phase if we're producing oils, where we extract the resin from the flower using technology, or the other alternative is that as a flower is a finished good, we another processing step before we package and distribute through our networks. So I think just to finish off with this slide, one thing that we've really tried to do as a company from day one is to talk to the market about what's really important, and we do believe that we have got a reputation for delivering on the things that we say that we will do. And I think that's really important in this industry, but it's been a massive year for us. The TGA GMP manufacturing license was significant several months ago. Increasing our capacity in our expanded site gives us global scale now and presence to maximise the opportunity both here in Australia and overseas. The health insurer partnership, it's all about driving value back to patients, which is critical, particularly in a time when we're many years away from there being a PBS cover for these types of medications. Fulfillment into Germany has been a 2-year plan, so that was huge for us. And although 2,400 bottles is not a huge order in terms of what we're trying to achieve into that market, it was a significant shipment, and certainly the first and largest shipment that we've seen from Australia. But what's ahead for us is really critical. We believe next year will actually be our true breakout year as a company. One of the big things we'll be announcing is a very large ethics approved study. And we've been working really long and hard on that as a rollout, and it has multi-layers to how we'll be rolling that out both here in Australia and eventually into the European markets as well. We're working on pathway deliveries into New Zealand and South America at the moment. And our first shipment of flour is due, as I said, early next year into Germany to our partner in DomaCom, which is a local partner in country. We constantly have a meet the market strategy. So we're looking at the market, talking to the market, what are the products that are beginning to move and shift? And we saw in the back half of this year, there was a significant shift into flour-based products for Australia. So our first flour product will be available for Australian patients in January, but we're also transitioning into other ratios of cannabinoid medicine into the start of the next year as well. And we will see a rapid development of our ARISE technology with Curtin University next year. So we have a 3-phase approach with Curtin, where we've begun phase 1, and we'll be obviously talking to the market as that one progresses into the new year as well. That's a really quick snapshot of the company. Thanks everyone for your time today, and thank you very much to Tim and the team at ShareCafe.
Paul, we've got time for one quick question. We're actually out of time, but and a quick answer if you don't mind, how important was that shipment to Germany, and how big is that opportunity?
Yeah, Tim, really quickly, it was probably the biggest announcement for us as a company. That market represents a huge opportunity for Little Green Pharma. As I said, there was Tilray and Aurora, the $2 billion Canadian companies, and Little Green Pharma became the third. So it's the first step of many that we believe, and in fact, on the back of that, we'll be looking to bring on a local team and replicate our sales and marketing success that we've achieved in Australia into that local market in the new year.
Thanks, Paul. That's all we have time for. Have a good Chrissy. We'll see you next year.
Thanks a lot, Tim. Thanks, everyone.
Next up, we have Seralto Limited, ASX code CRO, market cap of $57 million. The stock has had a lazy one-year return of up 350%. The company engages in the growth and commercialisation of technology assets. The company enables their customers to be better businesses. We have with us the CEO, Adrian Float. Thanks for your time, Adrian. Over to you.
Mate, thank you for having me. Good morning, everybody. As Tim said, my name's Adrian Float, and for my sins, I am the MD of Seralto. If you could change slides for me. In a nutshell, we help our customers to get paid what they're owed on time. And I suppose what many people are probably well aware of, that more than half of the time people get paid late. And getting paid late causes all sorts of issues within an operating structure. And I suppose what we've done is created a collaborative platform that really stands us apart from others, where we can solve what is a $100 billion plus problem in the Australian market by allowing buyers and sellers to collaborate and connect their general ledgers. So our key special sauce is we're bundling the e-invoice and the e-payment, so that really when we look at the overall payments life cycle, the bit that gets done by the banks, just that last 5%, we're playing right across from how a transaction gets formed, to how a transaction gets processed, to how the transaction gets receipted at bank, right the way through to reconciliation. And we're doing that end to end. If you could change for me. 2020 has definitely been a standout year for us. As Tim mentioned, it's been a fairly lazy return. And I suppose the reality for us is that COVID has pushed businesses to think digital. And for an organization like us, that's been wonderful, because we're all about looking at problems objectively and saying, hey, you know what? Do we need to live in the status quo? And could we do this better? And I suppose, as has been our performance really since our launch in March, and then subsequent launch in June of our spender products, we've seen double-digit growth in customers. So last month was about 42%. We've seen our payments ecosystem grow. And thanks to our capital raising partners with Kai and CPS, we've been able to set ourselves in a very strong financial position to tackle 2021 head on. If you could change. So a little bit about us. You can obviously see where we started to grow, and I suppose we started the year right at the bottom of what we saw as being our payments peers, and we're coming to end the year somewhere around the bottom of that mid-tier section. So we're pretty happy with what we've been able to achieve, but 2021 is what it's all about for us. As some of you might be aware, we have recently announced an agreement with Fiserv and Visa. That's a transformative piece for us. It drives our margins, it changes our cost of sale, but more importantly, allows us to pivot our business model. If you could change for me. Thank you. So looking at our organization today, we've got a very large customer base. And I suppose being a software business, transitioning and bundling together financial services with software, we've got this large incumbent customer base that we really want to transform into payments. So the great thing about that is we're not having to go hunting per se, but our technology is very horizontal. So looking at the markets where we can play, yes, our addressable market's growing. Yes, we've processed $2.2 billion of transactions via our software ecosystem. Our objective is to take that 2.2 billion and grow it, and then convert it to merchant fee income. So under that BPSP play, our margin uplifts about 40%. Now, looking at that practically, ultimately, and in simple terms, that makes a small $2 million business worth somewhere about $1,000 a year to us. Now, sorry, $1,000 a month to us. I apologize. Now, at those kinds of numbers, there's obviously lots of businesses. We could very happily just work in the sort of 2K circle around us and make a very nice business for ourselves. However, our focus is to, first of all, dominate the Australian landscape. We're very comfortable with our unique point of difference in their B2B landscape. But moreover, we've got some acquisitions planned in the new year that round out our IP, give us access to a new customer base, but also allow us to increase our margins even further than we have in the past. If you could change for me. And again, yeah. So this BPSP agreement, well, we're in rare air here, and it's been a 7-odd month process to jump through the various hoops to be where we are today. And obviously that's a significant achievement for us as an organization. We have alluded to our work with the card schemes over the last probably 4 or 5 months. Bringing that to fruition now is all about us being able to own the cardholder better and understand the cash flow needs of our customers and look at how we can blend those two things together so that ultimately everyone's getting what they're paid, what they're owed, and we have a great opportunity to really drive down the cost of funds within an organization and really improve their liquidity and working capital access. Next, please. In terms of business model enhancements, as I'm sure most of you know, businesses tend to operate in a terms of trade framework. So they don't, and COD is the exception. So by terms of trade, I mean, you owe me this invoice in 30 days time. For us, these new BPSP arrangements really allow us to look at pivoting pay by installment opportunities and looking at how we can use both open banking and our new merchant capabilities under the BPSP to utilize collection processes more effectively so that we can provide buy now, pay later services, if you like, into the B2B landscape. That really rounds out our play. If you look at our retail offering, we have both FPOS, virtual terminal, e-commerce, and accounts receivable payment services, which really means we can go after the traditional bill presentment platforms. And we believe that those markets in that retail space will open up significantly in the new year. Equally, we then can pivot backwards and look at how retailers actually pay their distributors and or manufacturers. Now, those business model changes mean for us that our lick of the lolly, if you like, in terms of the overall payments ecosystem is far more substantial than what traditional payments vendors have been able to obtain. Next, please. So looking at the overall payments market, you've kind of got two principal ways in which businesses pay one another. So the first one is that bill payment platform. So your sort of BPay approach. And BPay is fantastic for improving the reconciliation and identification of for a supplier where they've got many, many merchants. However, they add no value to the customer or the person making the payment. In fact, if anything, they're slow, cumbersome, and ultimately really that quite an inefficient sort of traditional thinking approach to how we want to get paid. But if you flip that around the other way and you look at it from the buyer's perspective, when we use ABA files via our internet banking, that's great for me as a customer making the payment, but not so good for my supplier. And ultimately what that means is that the supplier's got increased reconciliation time to recognize the payments that I've made. Now, when we look at that practically, we're bringing the best bits of both those capabilities into a collaborative platform so that if I make a payment, it's reconciled in my financials at the same time when I make the transaction. But equally, we're delivering a electronic remittance that can be applied to the supplier's financials so that their ledger is also up to date and reconciled in the same way that BPay does. So that midpoint for us, we see lots of scale in that space and lots of opportunity for us to continue to really drive down that late payment issue that's just pervasive in the Australian economy and even more pervasive in the US. If you look at some MasterCard research, they're suggesting that 80% of invoices are paid late in the US marketplace. Next. So with that most recent announcement, we're really looking at, we've got sort of 4 strings to our bow. We've got that, I'll call it direct payment, where we've got a number of technologies that can support a customer paying a supplier. But our key differentiator there is we support statement-based payments. So a customer can actually, if you like, pay a manifest of invoices to a supplier. And when we post those payment events to the supplier's bank itself, they actually see them as individual itemized payments. So that's a big change in terms of merchant payments. And that's a huge opportunity for us. We've also got our intent to pay framework, which really supports supplier funded payment arrangements. And I'm guessing I'm going to get the wind up, so I will accelerate. Right now, the funding scenarios that exist in terms of partnerships, we've made announcements last year about our working in the credit space. We've now got to a level where that is accelerating, and we believe there's fantastic opportunities to open up, if you like, extended credit to buyers, as well as instant payment to suppliers, and using our payments technology to really manage the instantaneous settlement and collection of debt payment. I think I'll maybe skip this one because we're going to run out of time. And this one, they're good slides though. I suppose really where we sit in terms of benefits is by delivering collaboration. We're breaking down traditional barriers that exist between buyers and sellers. And when you break down barriers, you remove credit impeding the sales relationship, and you allow the business relationship to be far more effective. So there's better cash flow from the buyer's perspective, there's better cash flow from the supplier's perspective, and ultimately the sales machine is more effective. With the reconciliation piece, we're obviously saving time, and we've had a really good response from the Institute of Credit Management and the accounting fraternity as far as supporting our payments passport as a methodology to improve overall credit management within business. I think and really we're flowing that through to both buyer and supplier. From a supplier's benefit, look out for where we're going with workflow payments. It's a real game changer. Ultimately, what that's all about is utilizing the card itself as a security mechanism to guarantee performance by the buyer. So if you think like Uber, that's what they're doing in their closed economy, where we all know that our credit card is telling the driver that Adrian's going to pay for his ride when he gets out, but the charge doesn't happen until the service is rendered. We're bringing that same logic, but much more pervasively into the ecosystem so that we can license technology to the software industry that allows them to take that approach. That means true COD. It means a change in the way e-commerce is done, and a much better methodology for how we can actually expose service providers, for argument's sake, to the payment cycle, so they've got less risk in their collections. Next, ultimately how we make money, software as a service, we charge subscription fees, but moreover, we make a percentage of the turnover through our network, hence why we focused on growing our merchant turnover numbers and reporting on those consistently through the 2020 year. And as you can see, because we can move through the entire payments value chain, we're able to turn the original purchase of a cup of coffee from a consumer into a much bigger transaction flow by connecting all the players together. Next. And again, so I suppose our opportunity is to continue to bundle. We're competing against the traditional financial or payments players by offering our customers a better or lower total cost of ownership of their business stack. So we're using the software itself as a vending machine for the payments transaction. And by doing that, we're able to more effectively compete against our software competitors, because they are not deriving that income, if you like, or that clip of the ticket out of the payments process itself. So they've got to hold up their software revenue and hold up their software costs. So that bundling approach and our approach to go free with payments has been very effective for us in acquiring new customers. Next. The suite's pretty broad. There's no way I can explain it all in 10 minutes, but suffice to say, we're providing enough tools for businesses all the way through the value chain to run their operations upon. and then connecting them to the payment ecosystem. So we're all about helping our businesses to form more effective transactions that ultimately result in a payment and settlement. I think that's me. Over to the questions.
Adrian. Great presentation, a lot in there. I'm actually astounded being a business owner, chasing invoices with ASX listed companies and financial institutions. So it is an enormous market for big and small businesses. So how does it practically work for a business like ourselves?
Well, I mean, basically in a nutshell, we've got a 3-layered implementation process. So the first layer is all about compliance and knowing who you are. Once we've got through that step, which is not onerous now, thanks to our new agreement, we then move into really connecting your financial system into the ecosystem and then inviting your customers to play. Once your customers are in, we effectively create a secure link between your accounts receivable and their accounts payable, and then allow that payment event to flow. So you can use that for single invoices, statements, payment arrangements. There's a plethora of scenarios that we're supporting, as well as I said before, we're moving into that buy now, pay later or installment payment framework where, hey, you know what, you might want the money now, and we'll provide mechanisms for you to access credit in real time. And that's a big difference. So one AML KYC suite, many applications right through the payments ecosystem. Yeah,
it's clever. It's clever, Adrian. We've got lots of questions, so I might follow up with you during the week with an article, but lots of questions about offshores. Can we just kind of have a quick Q&A on that? What's your plans
offshore?
There? Yeah, about your international plans, given your, your relationship
good question.
with your MasterCard and things like that.
Yeah. Well, I suppose in a nutshell, little companies don't normally get the Guernsey that we've got. So we're probably like a rough rookie pick. But we think we're gonna reward those bigger, Fortune 500 players for supporting us. Definitely global is what it's all about. But right now, we've got some clear deliverables in the Australian market. We want to cut through profitability. And to do that, we just need to do a little bit in the Aussie market. It's not a long way for us. Really, our planning in terms of global is all about some of the security steps we're taking at the moment, as well as really beefing up our open banking integration. So the great thing about Australia is we're heavily regulated, and all the regulations that apply here transfer very easily to the European and US markets. But they're really back half of 21 for us, where they become, I'll call them serious and strategic plans.
Great, Adrian. Thank you for your time. Have a nice Christmas. We'll follow up with some content during the week if you're free.
Fantastic. Sounds like a plan.
Thank you.
Cheers. Thank you, everyone.
Next up, we have Vulcan Energy Resources, ASX code VUL, market cap of 163 million. It's had a lazy one-year return of almost up 1,300%. The company is aiming to enable 100% green electric mobility transition by becoming the world's first zero-carbon lithium producer, a subject that is subject to an announcement by the European Commission today, which basically said that car and industrial batteries sold in Europe will soon face legally binding environmental standards as it seeks to give local producers an edge in a rapidly growing market. We have with us the CEO and founder of Vulcan Resources, or Vulcan Energy, Francis Wedin. Over to you. Thank you, Francis.
Thanks so much, Tim. And thanks for having me on as well. So yeah, today is really very exciting for us. It's really a combination of the strategy since we started Vulcan, and we've really been building up to this. So now the regulation has been announced. It's coming in. It's really an exciting time for Vulcan, we believe. So yeah, just a quick summary on Vulcan. We were set up to deal with the high carbon footprint of the existing lithium chemicals supply chain, obviously flowing into lithium-ion batteries and electric vehicles. We are Europe focused, and Europe is 100% reliant on imports for lithium chemicals. and China dominates 80% of supply of lithium hydroxide, which is essentially what Europe needs. So there's a strong supply-demand thematic and strong strategic reason for setting up local supply in Europe, which is heavily supported. We are the world's first zero-carbon lithium project, as you pointed out. We have a registered trademark for zero-carbon lithium in major jurisdictions. We also have IP protection around our process. We've really been designed from the ground up to be zero carbon from the beginning, and I think that really is showing now. We really started with a blank slate and worked backwards to how to create a zero carbon lithium company. So this is not a greenwashing exercise. We are a direct lithium extraction and geothermal energy project in Germany, essentially producing renewable energy and lithium chemicals from the same resource, which is a deep geothermal brine in the Upper Rhine Valley of southwest Germany. This gives us dual revenue from both lithium chemicals and from renewable energy. So we'll be publicizing figures on that soon, hopefully as part of our pre-feasibility study. We are in the heart of the fastest growing lithium market in the world, the European market, albeit growing off a smaller base, but growing faster than China. We have the largest lithium resource within that market. And we are a rapidly advancing project with a very strong technical team supported by the European Union, or organizations backed by the European Union. And we have existing agreements in place that give us access to the brine as well. So that's just a quick summary of the company. Next slide, please. We were set up essentially to avoid this number. We've undertaken a life cycle analysis of the lithium hydroxide supply chain. This third-party analysis shows that essentially if we go down the hard rock route with downstream processing in China using predominantly coal-fired power, over 1 billion tons of CO2 will be emitted to produce enough lithium to transition to electric vehicles worldwide. That's equivalent to the annual emissions of France, Italy, and the UK combined. So it's a very big number that we have been set up to avoid. Next slide, please. From a European supply perspective, it is very difficult to, as well as problematic from a carbon perspective, it's also very difficult to permit hard rock mines in Europe. It is a densely populated area, and open pit mines in particular are very unpopular. Obviously, underground it doesn't really work from a lithium perspective in terms of project economics, and open pit very hard to permit. So we see that as probably being not the best option for European supply, which is why we're focused on geothermal brines. There is also obviously the supply option of external supply into Europe from places like South America, where they have continental salars. These have a lower carbon footprint than hard rock. Clearly, they do still have a reasonable carbon footprint because of reagents that are used in the process and the fact that they're very remote, but nonetheless lower carbon footprint than hard rock. However, very high water footprint in the second driest place on Earth, the Atacama Desert. And this has been widely reported as stressing local indigenous communities and local environment as well. So we think the current supply chain for lithium in Europe is suboptimal at the moment, and that's what we are setting out to change. Next slide, please. And just lastly on the macro, so Europe is growing off a very small base to rapidly become a major center for lithium-ion battery production, not just lithium-ion battery production, cells, cathodes, and soon to be raw materials as well, all the way up to electric vehicle production. The Europeans are pushing very, very strongly to capture this entire supply chain within Europe. Why? Because the lithium-ion battery is essentially the engine of the cars of today. They're transitioning to electric vehicles incredibly quickly, so they don't want the engine of their vehicles. The automotive industry is one of the largest industries within Europe. They don't want the engine of these vehicles to be built overseas. They want to capture the jobs and the value chain within Europe. So very strong push backed by the European Battery Alliance to increase battery production very, very quickly. This is causing a rapid increase in lithium demand as well. It seems to be, from customer feedback so far, seems to be 100% lithium hydroxide demand as opposed to carbonate. And added to that, in addition to the statements from the surrounding the European Commission regulation yesterday, we also have the likes of Volkswagen coming out and saying that they want to produce net zero carbon electric vehicles. Obviously, this is partly driven by the regulations that are coming out, including all the raw materials that go into the lithium-ion batteries. And they've said that they'll use sustainability on par with price, which obviously tells us that a sustainable product is potentially a premium product. Next slide, please. So with that in mind, how we started out with Vulcan, we were looking for geothermal brines with a high lithium grade and high potential flow rate. So the geological conditions that would allow us to have a commercial geothermal lithium operation. We scoured the earth to see where this could be done. We essentially ended up with two main areas which were standouts. One was the Salton Sea in California. The other one was the Upper Rhine Valley in Germany. Also goes into the French side of the border as well. As mentioned before, we are very focused on the European market. So we entered into Germany. Germany also has a very supportive feed-in tariff regulation for geothermal energy produced as well, which was another reason for going to Germany. Next slide, please. So we started out in Germany. How the company started off, we attained a large license position, nearly 1,000 square kilometers of granted and application licenses. The Upper Rhine Valley is a graben system, and it's one of the most well-explored graben systems in the world, has been explored for oil and gas and geothermal for decades. This has generated an enormous amount of exploration data, which we have been able to leverage off, essentially, some of which is available for free, some of which we've purchased. So this is drilling data in the area. This is seismic data, 2D, 3D seismic, and this really allows us to visualize the subsurface and to do our resource modeling. So we've upgraded our resource a number of times over the last few months, and we'll expect to do that again in the future. Essentially, we have the largest lithium resource in Europe now by quite a large margin. Why is that significant? Well, we think that OEMs and other corporates in Europe want to really partner up with a project that has scalability, and we have scalability here. So we are able to just add more production wells to increase production within this very large reservoir. Next slide, please. Just a quick snapshot of some of the news that's been coming out over the last month or so. Really, it's every couple of days, every week at the moment, there's something new that comes out. It is a very exciting space to be in, the European battery market and the flow through to battery raw materials as well. So just a snapshots of that there. But really, what's incredible is we're seeing penetration rates for electrified vehicles in places like Germany, which are very large markets indeed, reaching 20% now, up over 300% year on year. Places like Norway have been ahead for a while. Norway's touching 80% now, but to reach 20% in a market like Germany is really a watershed moment. Most of these jurisdictions now have very strong targets for stopping selling internal combustion engines 2025, 2030. That is not far away. So there's a very quick transitioning to electric vehicles happening, and that is having a flow-through effect to lithium as well. Next slide, please. This is where we're located, so right in the center of that nascent but very fast-growing and very exciting market. Just of note there, we're not the only ones trying to be zero carbon. We are the only zero carbon lithium company, but further down the supply chain, so the likes of Northvolt, locating next to zero carbon sources of power, aiming to produce the greenest batteries in the world. And this is all being driven by these European Commission regulations, as well as people obviously wanting to decarbonize as well. It being sort of the right thing to do, but there's also a financial reason for doing so. Obviously, with the EU regulation coming in now, batteries must comply with these carbon thresholds. And simply put, consumers want to buy low carbon or zero carbon batteries now. So this is the way the market is going. Next slide, please. So how does our project work? Just at a high level, we are developing geothermal projects in the Upper Rhine Valley. So it's deep geothermal. We drill deep wells into the reservoir, which is predominantly in a unit called the Bunter sandstone. We pump up hot brine to the surface. This is not new. This is being done as we speak in the Upper Rhine Valley at a number of plants. And new projects are currently in development as well, separately to us, to produce geothermal energy. We will be doing the same. We pump the brine up to the surface. We produce energy from this brine. We can produce electricity and heat, depending on the time of year, which is a real advantage for geothermal. The brine then gets run through a direct lithium extraction plant, and it gets taken out in chloride form. The brine is then re-injected, just minus the lithium, and the eluate rather the lithium chloride eluate is then concentrated up using the heat from the geothermal plant. So we use 0 fossil fuels to drive this process, and then we produce a lithium hydroxide product off-site at a chemical park. Throughout the whole process, we don't use any fossil fuels. We produce more energy than we need. We're a net energy exporter to the grid. So this is, as I said, this is an energy business as well as a lithium chemicals business, and hence the zero carbon lithium product at the end. Next slide, please. At a high level, the flow sheet is broken down into 3 sections. The binary cycle geothermal plant, as I said, nothing new there under the sun. It is currently being done in the Upper Rhine Valley and elsewhere in the world. Very well understood process. Direct lithium extraction, less well understood, however, already commercially used on brines, albeit a different type of brine. So we have been doing test work, which has been going very well so far on our geothermal brine, and we'll be further de-risking that and upscaling it next year. But essentially, we have this expertise in-house. We have some of the leading DLE experts in the world working for Vulcan. It's a very niche industry, within a very niche industry, I would say. So we're lucky to have that expertise on board. And then the lithium refining plant, depending on which route you choose, whether it's the so-called traditional route with a carbonate step first, or whether you go straight to hydroxide. It's a very, well, the former is very well understood. The latter, there's a very similar process in the chlor-alkali industry, which is currently being used. So that's just a breakdown of the flow sheet. Next slide, please. Just a bit more detail there. So brine comes up at 165 degrees C. We use about 100 Kelvin in the geothermal plant. So it comes off at about 65 degrees C and goes through the DLE plant. And at the back comes your zero carbon lithium trademarked premium product. Next slide, please. Just a bit of a snapshot of what we expect to be publishing in the pre-feasibility study soon. So we will be developing a number of geothermal plants, each serviced by a number of wells. So shown there in red, these will be energy operations. There will be a DLE plant attached to each one. And depending on where you are in the system, each area can produce probably slightly different amounts depending on the flow rate. And then you have a central lithium plant, which we're looking at some chemical parks located around Frankfurt as possible locations. We transport the lithium chloride concentrate to those chemical plants. We can either use barge along the Rhine River, or we can use electric trucks, depending on where we are in the project area. Next slide, please. Just to mention, we've talked a lot about carbon. We have quantified this, as mentioned. We do sit at essentially a negative carbon point compared to roughly 13 to 15 tons CO2 per ton lithium hydroxide produced for existing and potential future supply for hard rock. As we mentioned, solar type brines, lower CO2 footprint, but very high water footprint, which is not shown there. So life cycle analyses rather very important when you're speaking to potential off-takers. Next slide, please. What this means for a potential off-taker, such as the Volkswagens of the world, Volkswagen planning to produce 28 million electric vehicles by 2028. We estimate this will produce 19 million tons of CO2 emissions just from the lithium required if they source that from hard rock. Essentially, we can get that to negative 7 million tons of CO2 using our process. Just to clarify, we're not taking CO2 out of the atmosphere. That is a net offset effect of essentially feeding energy into the grid and offsetting brown coal on the German grid. But we are a zero fossil fuels process, hence zero carbon. Next slide, please. Just a note on, I guess, what this project will look like. We hope to talk about CapEx, OpEx, NPV, IRR very shortly as part of our pre-feasibility study. But essentially, geothermal projects of this nature are well known to be high capital intensity. So there will be a high CapEx associated with this project. However, we are building 2 businesses here. We're building an energy business as well as a chemicals business, and each with self-supporting, profitable revenue, essentially. So there will be a reasonable CapEx up front. However, once this is in production, we would expect this to be one of the lowest OpEx operations in the world. Why? Because we're able to leverage off that freely available heat from the plant to drive the process. And obviously distance to market is a factor as well. So we expect this to be a very low cost operation indeed, very well insulated from any price shocks. And we're also supported by the 25 cent per kilowatt hour high feed-in tariff for geothermal energy. So the geothermal part essentially pays for itself and makes money. And essentially, this is a very big strength of the Vulcan project in that we can carry on producing energy regardless of how much lithium we produce, and we can keep that payback going. So a substantial de-risking effect. Next slide, please. Just a note on our board. So we do have very strong geothermal energy expertise on our board. Dr. Horst Kreuter has been involved in starting the first geothermal company in Germany back in the 90s and has been involved in geothermal project development ever since then. He comes with his own development team and is really sort of very well placed to lead this forward. We also have strong ESG and impact investment expertise on our board with Rania Al-Kanamani, and investment banking expertise with Gavin Rizos. Myself, I come from a lithium background. Next slide, please. In terms of the technical team, these are the guys that really make it happen. We have very strong expertise both on the lithium side, direct lithium extraction, chemical engineering, a lot of PhDs and some very smart people there. And also on the business development side, experienced lithium industry people and ex-Tesla people working for us as well. So a really exciting and dynamic team to lead us forward. We do expect this team, which is predominantly located in Karlsruhe in Germany, to grow substantially into early next year, really as we transition to much more of a development company. So expect to see this grow substantially in sort of Q1, Q2 next year. Next slide, please. Just to mention, we are supported by an EU-backed group, EIT InnoEnergy, and we do expect that to help with fast tracking of the necessary licenses to take this forward. And also, EIT InnoEnergy is assisting us with speaking to off-takers as well. So good to have that sort of EU tick of approval for the project. Next slide, please. So where are we in the project? We have completed a scoping study. We haven't publicized metrics around the project yet, NPV, IRR, etc. So we're very excited to do so. Our pre-feasibility study will be our first opportunity to do so. We are working hard to get that out before the end of the year. So the guys are working extremely hard on that at the moment. Obviously, not much of the year left. So should there be any delays, we would push into Jan, but we're still working hard to get that out by the end of the year. Next year, we'll be starting our definitive feasibility study, and we'll be also pursuing offtake agreements between our PFS and our DFS. We'll be scaling up and de-risking the processing as well, and really trying to get this to a bankable stage in as short a time as possible, targeting 2024 for first production. Next slide, please. Just a bit of a snapshot there. This is a bit of a fast-moving target. I know we've had some moves today, but yeah, essentially sitting at I think just under 200 mil market cap now. Management are the biggest shareholders in the company, are very strongly incentivized to take this forward. We have a good cash position for what we need to do for now. So yeah, company is in a very strong state at the moment. Next slide, please. And that's essentially it. So world's first and only zero carbon lithium process, dual revenue potential. Hopefully give you some numbers on that shortly with the pre-feasibility study. EU backing, Europe's largest lithium resource, center of the fastest growing lithium market in the world. Really the right team for the job to take this forwards. And yeah, exciting day for us with the European Commission regulation announcement surrounding CO2 footprint thresholds for lithium-ion batteries in Europe. Thank you very much.
Thanks, Francis. We've got a bit over time, but it is the last webinar for the year and we still have a good audience. So if you don't mind, a couple of questions. That EU announcement today, has that turned a screw on lithium-ion ESG? And how does that affect Vulcan?
Yes, yeah, I think so. I mean, I think it's a bit of a watershed moment, really. I think, some commentators have sort of been, writing off the carbon footprint side of things as a bit of a gimmick. We've always disagreed from the very beginning. We've said this is very fundamental to the way Europe's going and indeed the world is going. If we're going to achieve our climate goals and the very ambitious goals that each country is setting. The current status is that electric vehicles take a lot of carbon emissions to be produced, and that's predominantly because of the metals density of the batteries, particularly the cathode. And that needs to be fixed. They are still greener than fossil fuel vehicles, even with the current status quo. But the likes of Volkswagen, Daimler, BMW, they know very well that they can't have another Dieselgate essentially. So I think all the OEMs are working very hard to make sure that the transition to electric vehicles is done in a very sustainable manner and in a ultimately in a zero carbon manner as well. So I think it's very much right place, right time for a company with a a strong goal and plan to produce zero carbon lithium.
I mean, you are one of the founders of the business. Was this part of your vision in terms of how the EV battery market would play out and the demand in Europe?
Yeah, well, I mean, this is our very reason for forming the company. So I come from a hard rock lithium background myself. Essentially, I think it was a couple of years ago that Volkswagen first started talking about producing a net zero carbon electric vehicle, including the raw materials. And I'd never seen, any potential off-takers speaking about wanting, zero carbon products before. This is really creating a whole new market. So they started messaging it a couple of years ago when we started. And this is really coming to, this is really becoming a reality now with these regulations.
So essentially, you see Vulcan being the first lithium producer in Europe?
I don't know if we'll be the first. We're moving very, very quickly and we're pushing very, very hard. Certainly with because all the other projects currently are hard rock projects. They generally require some sort of converter to be built in Europe, which doesn't exist yet. We wish everybody well who is in the lithium space in Europe, and I'm sure they wish us well as well. It's not a zero-sum game. The size of the size of the prize, the size of the market really means that we're not really competing in that respect. So it's very collaborative. Everyone is working together to essentially start a lithium business, a lithium market in Europe that hasn't existed before. So I don't know if we'll be the first. We'll certainly push very hard, but I don't think that's too critical to what we're trying to do. I think there's plenty to go around.
Thank you, Francis, and congratulations on an outstanding year for Vulcan Energy.
Thanks very much. Thanks for having me on.
Okay, that's all we have time for this year. We thank you all for your participation in these webinars. We'll be back probably January 15. Have a nice break. Have a nice Christmas. See you then.